Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same 4 LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices. While we expect 53 to be the next rally staging post, liquidity providers assess $140 silver would provide the most likely staging point to bring sufficient bullion to market.
Andrew Maguire warns that London has lost control of the global silver market as physical shortages deepen. China's new silver export controls have tightened supply, while offshore Shanghai exchanges face intense bidding from global buyers. Despite appearing stable, COMEX inventories are mostly paper-backed and can't meet physical delivery demands. LEMA members are rushing to move limited silver from the US to London, but this only delays potential defaults. Lease fees are soaring, and traders refuse to lend metal amid growing distress. Global spot silver prices are hitting record highs in most currencies except the US, where futures remain artificially suppressed. Maguire says the only real solution is for major bullion banks to buy back unallocated silver with physical metal at higher prices, potentially pushing silver toward $140 per ounce.
London has lost control of the global silver market. We said it last time. It is now so clear it's hard to ignore. Unprecedentedly high risk, unfulfilled local London lease fees illustrate both a lack of trust to lend metal into global supply tightness. So, why you can't trust it? It's too risky. These spreads could be closed at any time. And while registered COMEX inventories appear to be in adequate supply, that is enough to cover a rush of delivery demands, really, as it looks at face value. These leveraged CME warehouse receipts are inequitably hedged against an unfactored lack of local London supply. This is why US lower-priced US-denominated bullion is slow to be shipped out to capitalize on up to a massively, as I say, attractive $15,000 profit per contract. Silver actually should have immediately been flown out last Thursday, last Friday. 160 SI lots would equal 25 tons. You could put those in on a plane for a matter of a few extra cents per ounce. Yet it was very slow to move. And this is really what we're drawing attention to. And while we're evidencing some profiting from shipping US bars to London, and we'll look at why this will not lower the higher spot price to meet the lower futures price. In fact, the opposite is going to happen. So minor short-term volatility aside, it's the record high global spot prices in every single other foreign exchange currency, no matter which one you look at, across the board. Spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious. It's mind-boggling and yet we look at them, listen to Main Street here, I'm on Bloomberg all the time. While they are caught onto gold, they have no idea that the silver market's broken and how undervalued dollar silver is. And that reflects what it is doing is reflecting really the supply shortages with this effect forcing the US silver prices much, much, much higher. The US is the sole outlier and is being targeted. And while the LBMA clearing members are facing default and are really racing to fly out what little silver bullion they can from the COMEX registered and eligible stocks into London, this is largely serving to satisfy immediate, unallocated, over-the-counter bets that have been called for delivery into empty local London vaults. It's just really keeping pace, trying to keep pace with an immediate default. Notably, illustrating it takes higher prices to bring silver to market. So it's evident this basis EFP spread and lease costs, they expand significantly into lower prices. They contract into higher prices, but literally expand significantly into lower prices. Nobody wants to lease this out. And while inbound US silver shipments are serving to relieve some of the EFP basis spreads between the COMEX futures and spot, currently still averaging a deeply backwardated, I'm looking at it right now, deeply averaging a dollar spread. I mean, that's still $5,000. And we've seen it's about plenty of time to have shipped out silver to meet this demand. It's not hard to put 25 tons on a cargo flight. So global physical shortages is really, what they're going to do is really quickly absorb anything that arrives in London. In fact, while shipments are serving to avoid an immediate default, the only solution actually is to bring more bullion to market. It would have to be at higher prices, because otherwise it's not going to be offered. Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same 4 LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices.
Andrew Maguire warns that today's silver crisis far exceeds the 1979 to 80 Hunt brothers squeeze. Unlike that event, which was confined to COMEX, the current turmoil is global. Physical liquidity has shifted to the Shanghai Gold Exchange International, weakening Western control. Maguire highlights that massive unbacked silver derivatives, handled by JP Morgan and Citibank on behalf of the Federal Reserve, are being exposed. A new regulatory rule quietly limits oversight of these derivative risks, signaling panic among regulators. With insufficient bullion to meet delivery demands, liquidity providers estimate silver could reach $140 an ounce. Central banks and sovereign buyers are demanding physical delivery, forcing major clearing members to repurchase unbacked short positions at higher prices. As every major bullion bank turns long on silver, the Fed's paper liabilities are being revealed. The shift toward real physical pricing marks the beginning of a structural revaluation, potentially driving silver to historic highs.
Even into the 1979 to 1980 Hunt brothers short squeeze, these sort of backwardations did not exist. And whereas the Hunt brothers backwardations were able to be contained and cash settled inside the siloed COMEX, where essentially that's where the market was, now the price-setting physical liquidity has been captured by the Western-facing SGEI physical exchanges, influencing every other silver and gold foreign exchange cross. And as we previously ascertained, the quarterly OCC reports, the Office of the Comptroller reports, lists the historically accrued, unallocated, unbacked foreign exchange silver derivative bets being stick-handled for the Fed by the 2 remaining Fed agent banks, JP Morgan and Citi. Now, do you remember we showed the third quarter unwind of the 5-year derivative bets? That was an important point to note. But actually, out of the 4 LPMCL members, that's ICBC, Standard Bank, JP Morgan, UBS, and obviously, so basically, it's only JP Morgan that provides the only LPMCL cartel member that provides the conduit into the OCC derivative bets. So ICBC, Standard Banks, UBS and JP Morgan. Now, notably, and by absolutely no coincidence, last week's rushed together proposed OCC rule, there was a rule change. It slipped under the radar. I haven't seen anyone else looking at this. And what it was doing, it was attempting, this was in a legal announcement, which seemed to be missed by all the mainstream media. It was attempting to rein in bank supervision of exactly these kind of derivative risks. And I just made a copy of it. Quote, federal banking regulators unveiled a pair of proposed curbs on their supervision programs that would formally ban the use of reputation risk. Yeah. What about people that have been fined close to $1 billion for manipulating silver? Forget reputation risk. As an exam factor, so they remove that, and constrain what examiners can call out for criticism as, quote, unsafe or unsound practices. Got to curb it. Why? There's a panic on it. The rule would also encompass unallocated FX gold and silver captured in these quarterly OCC reports. However, given there is simply not enough bullion to meet upcoming delivery demands at current prices, it telegraphs a very, very large move higher. As I say, liquidity providers are assessing $140 an ounce for silver just to meet that demand. Forget anything else. And this is why there's been very few offers to lend silver into higher lease rates. Now, while remaining COMEX speculators have largely been cash settled, and I can see they're progressively, we looked at in the charts, progressively they've been rinsed out. Very large predatory central bank sovereign buyers will force backdoor COMEX loadouts, meaning they'll stand there for delivery, forcing LPMCL actors in related COMEX to buy back these asymmetrically imbalanced bets at substantially higher market prices, further tightening global supply, driving the global price, as I say, much, much higher. So in summary, with every single pulling bank long silver for their own books, every single FX currency bar the dollar higher, these unbacked FX silver liabilities undoubtedly sit on the Fed's books. There's just no doubt. And hence the defense of these very large, asymmetrically imbalanced, naked short COMEX hedges that have been left exposed by physical silver and gold being benchmarked against a real global supply-demand price outside the control of the LBMA CME cartel's ring fence. It is this physical market liquidity that is forcing a real supply-demand settlement price to emerge, and it's only just starting to emerge. These official silver futures short stops have sat at the prior silver all-time 2011 highs. We looked at that. And we've seen multiple attempts to defend these short bets with very little speculator open interest able to be rinsed out, which is currently being attempted every day.
Andrew Maguire reveals that the global silver market is entering a structural crisis far deeper than past squeezes. Unlike the 1980 Hunt Brothers event, today's turmoil is worldwide, driven by physical shortages rather than speculation. Control has shifted from London and COMEX to the Shanghai Gold Exchange, exposing massive unbacked silver derivatives tied to JP Morgan, Citibank, and the Federal Reserve. A recent quiet rule change limits scrutiny of these risks, showing regulatory panic. With too little bullion to meet delivery demands, liquidity providers see $140 silver as likely. Central banks are demanding physical delivery, forcing banks to buy back shorts at higher prices. Maguire concludes that the era of paper manipulation is ending, and a true physical revaluation of silver has begun.